Okay, welcome everybody. I see that people are coming in. Let's get started. My name is Jess Boddington. I'm the Policy Director at the ABA, responsible for a range of different policy areas, including dispute resolution related issues. I just wanted to begin today by acknowledging the traditional owners of the lands on which we meet and pay my respects to the elders past and present. For us at the ABA, we're located on the traditional lands of the Gadigal people of the Eora Nation. But our member banks and their services are located across the lands of Aboriginal and Torres Strait Islander peoples all across the nation, whose 65,000 years of continued connection to country is a source of immense pride for us all. We're glad that you could join us today to discuss the complaints process for consumer and small business financial hardship cases. We're really lucky to have the AFCA team here with us to provide their insights around financial hardship related complaints, including their approach to complaint management, as well as recent trends and data. Before I introduce the AFCA team, I just wanted to let you know that we encourage your participation today, so please feel free to ask questions throughout the presentation. We'll pause a few times throughout the presentation to answer those questions, and you should be able to ask your questions via the Q&A tab, which is located at the top of the webinar. If you have any problems locating that tab, just give myself or Nat a quick email and we will we'll raise your questions as well. So in terms of the panel that we have here today from the AFCA team, I'll just quickly introduce you to everybody. We have with us Sue-Ann Russell, who's the lead ombudsman for small business and transactions at AFCA, which includes payment services, merchant disputes and scams complaints as well. Sue-Ann joined AFCA from Westpac in 2021, and she brought a lot of experience in the small business and consumer banking sector. We have Nat Cameron, who is the lead ombudsman for banking and finance, who prior to joining AFCA was the chief of customer operations for MLC Life Insurance, and before that, the CEO of AIA New Zealand. We have Paulina Stakowicz, the senior manager for financial difficulty at AFCA, who assumed her role in 2021, where she leads the financial difficulty area for case management. We have Chris Seamers, the Senior Ombudsman for Financial Difficulty. Chris has significant experience across AFCA dealing with matters concerning vulnerability and financial hardship, including in the Systemic Issues team and as an adjudicator. And we have James Taylor, a Senior Ombudsman for Small Business. James joined AFCA in late 2021, and prior to this, he worked in law firms in Australia and Canada, advising both lenders and borrowers, particularly with commercial and business loan facilities. So we've got a stellar team here with us today, and I know I speak on behalf of our members when I say we're grateful you can join us. So I'll just hand over to you now, Sue-Ann.
Thanks very much, Jess, and thank you for that warm welcome. We are really pleased to have this opportunity to talk to you today about AFCA's experience with financial difficulty complaints across consumer and small business. And we really hope this session will provide an opportunity for discussion about this difficult issue. And also thank you, Jess, for the lovely acknowledgement to country, which we also adopt. We're going to be using the term financial difficulty throughout our presentation to refer to hardship under the National Credit Code and financial difficulty assistance for small business. Today, Natalie Cameron and I will take you through some of our data to give some insights into what we're seeing through our cases, and Paulina Stakowicz will discuss the resolution rates. Chris Seamers will take you through the issues consumers are facing and the concerns they raise. Then James Taylor is going to look at financial difficulty for small business borrowers, focusing on the Banking Code of Practice obligations. And we'll also have some case studies to bring all this to life and consider too. Throughout our presentation today, you're going to hear our three key concerns. The first is that on top of a huge increase in financial difficulty complaints last financial year, we've seen a further 18% increase this year. We've seen the increase in personal insolvencies to pre-pandemic levels and corporate insolvencies exceeding those levels. It's not possible to read or see the news without hearing about mortgage stress, cost of living pressures, and small businesses not being able to meet trade credit timeframes, and concerns about reliance on short-term credit, including buy now, pay later for everyday items such as food. In this environment, it's in everyone's interest for banks to assist consumers and small businesses early when it could still make a difference. Secondly, financial firms, which includes the other ABA members outside the Big Four, have a greater proportion of financial difficulty complaints, and we're going to unpack this throughout the session. It aligns with the finding in the most recent ASIC report on hardship and indicates it's necessary to do a bit more work in this area, particularly around resolution rates. Thirdly, we've seen a year-on-year increase since 2021 in systemic issues relating to financial difficulty complaints, including debt recovery. Overall, there has been a 53% increase in referrals in the last year, and Natalie is going to provide a lot more detail on this in her presentation. ASIC's also indicated that hardship remains a priority, and further activity can be expected off the back of Report 783 published in May this year. AFCA's view is that it prefers to work with its stakeholders and the complainants to improve outcomes in this area, including for small businesses in financial difficulty. We consider it to be mutually beneficial if, whenever possible, that lending that might otherwise result in collection activity and shortfall can be triaged early with a better outcome for both parties. Natalie will also be discussing today the shift that we've seen recently in the type of financial difficulty complaints as we see more issues around the recovery process. I'm now going to hand over to Natalie.
Thanks, Sue-Ann, and great to be here. I am going to talk first about the banking and finance stats, but just before I do just want to stop for a second and recognise the great work the ABA has been doing, in the hardship space, including having us along to talk about this today, and also the connected area of vulnerability. Just an enormous amount of work in the code and related. So it is really heartening to see you all here today, and we'll try to keep it interesting. The case studies are great, and hopefully they'll give you a sense of how we work through these and how we make our decisions. So onto the stats. Not a boring looking slide of stats here, but let me just speak to it hopefully in a way that that makes it make sense. First off, just at the AFCA level, it's worth knowing that we have hit around 105,000 complaints in the last financial year. That is more than anyone ever anticipated AFCA would need to process, and the reason why we've had queues, and I will talk a bit about how we're getting through those queues. Around about, on average, 400 complaints come in per business day to AFCA at the moment, and it does not currently show much of a sign of abating. So where's it all coming from? Unfortunately, banking and finance is the largest contributor of complaints. Now, that's not to say that banking is a worse industry than insurance. It's probably related to the proportion of individual transactions that happen every day in banking, as opposed to, say, the more remote insurance transactions that might occur or that you might make in a year. But it is a lot of complaints, and so that we don't continually increase our fees and keep charging, our focus is really to give you as much information as possible about the complaints that we're getting, so that we can assist in the reduction of them. Our entire objective being to reduce complaints coming to AFCA and eventually to do ourselves out of a job. That's actually our goal and strategy these days. Now, 60,000 complaints into banking and finance. So I think it's around about 57% of complaints into AFCA overall, and that is up 12% from the previous financial year. One of the good bits of news here for banking and finance is 62% resolution rate. So for those of you who don't know, that's really the rate at which financial firms are resolving these matters at the front door. AFCA always sends them back for the financial firm to have a go at resolving themselves. And if they resolve right at that first stage of the process before they get to case management, they go into our registration and referral rate. So 62% is significantly higher than the other areas of AFCA. But you can imagine that if that rate drops with 60,000 complaints coming in, if that rate drops even by a few percent, it does mean a lot more complaints through for us to process each year. And that rate is down 3% year on year from last year. So we are keeping an eye on that and hoping to see the resolution rate stay steady at least and hopefully improve. AFCA is, if you look at the BF complaints closed, that blue section there, AFCA did increase its closures by 21% last year. So credit to the case management teams and registration and referral in particular, who really, closed the bulk of them. I think with our evolution of our process and with additional resourcing, we've really cut into the queues and done a lot more. I do want to acknowledge, though, there are still queues and we are still getting on top of them, including in rules. And I do just want to acknowledge that's been frustrating. 61 days on average to close a banking and finance complaint, which is up 7% as a result, again, of the queues. Now, just to touch quickly on the product types and issues, I think the product type, their personal transaction accounts, the top one and the top issue, actually the top two issues, unauthorised transactions and scams, all make sense together. We're still seeing, or at least in the past financial year, we're still seeing a sizable number of scam complaints. I do understand, and this may be mentioned later, but I do understand there's some really positive signs, though, in that space, and we're hoping to see less and less scams complaints coming through. In the remainder of the issues, interpretation of product terms and conditions, service quality is a perennial issue, and incorrect fees and costs. And I think there's a bit more information there about how much closes at each stage. You can see very few actually make it all the way through to decision, and only 8% to rules. Perhaps if I go to the next slide, because one of the areas, as Sue-Ann mentioned, that has really jumped up significantly in the focus of today is financial difficulty complaints. So as Sue-Ann said, they're up 18%. That is a concern for us, and we think that there's some opportunity to resolve these sooner. The resolution rate for financial difficulty, which includes hardship, as Sue-Ann mentioned, is only 46%. So if you compare that to the 61% for the overall banking and finance resolution rate, there seems again potentially to be an opportunity to resolve more. We have closed more, so we're up 31% on the previous year. But look, let's focus in on the issue types we've got mainly, and not just the issue types, but what's growing. I think that's probably the more interesting thing. So the first issue, the number one issue we have with a bullet, 50% of our complaints exactly, financial firm failure to respond to a request for assistance. That does include both a complete failure to respond to a request, but also in the complainant's mind, who's typing this in as they lodge their complaint, an inadequate response to their request for assistance. That's 50%, but I'll talk to you in a minute about how it's changed. Decline of financial difficulty request is the next category at 26%. Request to suspend enforcement proceedings, 15%. Default notice and then default judgment obtained. So they are our top 5 issues. And I might flip over to the next slide, please, Carla. Thank you. We've got Carla Petrosky in the background here doing our slides. Thank you. Here is how they've been moving across the last 2 years. So if you sort of start from the bottom, that failure to respond to request for assistance. That's 50% of our complaints, but it's only increased by 1% over the last 2 financial years. If you head up, though, to decline or request to suspend enforcement proceedings, they're the big movers. So they're where our increase in financial difficulty complaints are coming from, particularly request to suspend enforcement proceedings. So we think that suggests that more people are moving through to the enforcement stage and they're making more complaints about that stage. Default judgments also up 19%. If we flip over, I think we're now, who am I handing over to? Paulina. Paulina. I'll hand over to Paulina to talk about the resolution rates. Thanks, Paulina.
Thank you, Nat. So what we can see here is the resolution rate data for complaints lodged against ABA members in comparison to the average resolution rate on financial difficulty complaints across all AFCA members over the past 3 financial years. Since 2022, we have observed that as COVID assistance gradually came to an end, our members have been deploying more proactive approaches to managing accounts for their customers who are facing difficulties in making repayments. Pleasingly, this led to a gradual improvement in the resolution rate for financial difficulty complaints at AFCA over the last 3 financial years, as you can see here on the slide. And while there is still work to be done to bridge the gap between financial difficulty resolution rate and the overall banking and finance resolution rate, we are really pleasing to see the upward trend and hoping that this trend will continue this year as well. Now, in contrast, though, the data for ABA members indicates that resolution rate for financial difficulty complaints, with the exception of financial year 2022, was trending or has been trending below the average resolution rate for financial difficulty complaints at AFCA. As you can see from this slide, the resolution rate was the highest in 2022, but it has since decreased to 39% and 40% in 2023 and 2024, respectively. Now, considering the average resolution rate for all banking and finance complaints, which was 62% last financial year, and even considering lower resolution rate, average resolution rate for financial difficulty complaints, uplifting numbers of complaints that resolve early at AFCA remains an area of opportunity for ABA members. These results highlight an opportunity to analyze the current practices when dealing with customers experiencing financial difficulty and complaints involving financial difficulty, to identify key drivers for resolving these complaints early and to determine any necessary steps to increase the resolution rate on financial difficulty complaints. So now I'm going to hand over to Sue-Ann.
Thanks very much, Paulina. Now we're going to focus a little bit on financial difficulty in the business complaints for ABA members. And as you can see from this slide, we're talking about very, very small numbers out of the complaints into AFCA. There are some reasons for this, including that this issue is very rarely a standalone for small business complaints, so may not be picked up in these particular stats. We also hope that it's indicative of the good work that's being done to assist these customers and the proactive stance that Paulina just mentioned. But as you can see here, 88% of the complaints lodged against ABA members at AFCA relate to the Big Four banks, and only 12% sit with the other members. But to understand this further, the concentration with the big banks is largely a reflection of the amount of business done by these firms compared to other ABA members, because in fact, a lot of ABA members don't offer business banking. And this sort of is borne out by our claims experience. As we've already noted, what we want in this space is just for the banks to work with the small businesses experiencing financial difficulty, so that a better outcome can be achieved earlier. Because too often in a complaint, we see there's sort of things extend over a long period of time, and it's like the parties' minds aren't actually meeting, and the discussions are not sort of progressing to a point where it would be much better, and a much better recovery could be achieved, rather than things being extended out to a forced sale and even negative position at the end. Go to the next slide, please, Carla. Thank you. Now, on this slide, you can see on the left diagram the top 5 product types for all financial difficulty across ABA members at AFCA. And therefore, it's not surprising to see home loans leading at 61%, with credit cards second at 19%. Then you've got the personal loans around 10%, and in there the business loans 6%, and that 4% relates to other products that can lead to a financial difficulty claim. Now, if we sort of look to the second circle, this one is focusing just on small business. So it's the top 5 product types for small business financial difficulty complaints across ABA members. And so not surprisingly, as you'd expect, that lead product there at 76% is the small business loans. And then you can see in there very similar sort of numbers around credit cards, and where you have mixed products and the line of credit type products. And again, we've got a 3% that's just the other types of products that can be given to small business that can result in financial difficulty. So could we go to the next slide, please, Carla? This particular slide, again, just for the ABA members for the last financial year, is showing the top 5 issue types for financial difficulty for small business compared to all of the AFCA financial difficulty complaints. So you can see, most interestingly, across both, the largest category is the failure to respond for requests for financial assistance. We've spent a lot of time discussing what this can mean, from downright just failure to recognise, particularly in the case of a consumer, that the person has made a request for assistance, or that they have not met the requirements of, say, Section 72. In other words, it just wasn't picked up by the firm, to where the response to the complainant was just so unsatisfactory to basically not constitute an appropriate response. So we see this most often occurring where standard procedures are blindly followed. We see a lot of requesting documents that the person has already made clear they don't have, or they're just not going to be able to provide, without some sort of individualising the response so that it makes a sort of sense in the context of that particular loan, or failing to adopt processes where a person might have no access to internet or something like that because they're in a remote area or something like that. So this is an area where we would really like to see an improvement in, and I think we've been raising these sorts of issues in our regular stakeholder meetings. So we hope to see a decline in this sort of complaint soon. We are now seeing, again, across both areas, an increase in complaints around requests to suspend enforcement proceedings. This could be in part as people, either consumers or small business, reach the end of the possible financial difficulty assistance and options, but it is still concerning. I'm going to hand back now to Nat for some further analysis of these points.
Hi, everyone. Thank you. Some good questions in the chat. We're definitely sharing the pack. I'm not sure if the ABA, I assume, is sending it out via email, but certainly it'll be available by the ABA. And we do have some really interesting postcode data. It's not split by complaint type, for example, a request to suspend enforcement proceedings, but we will also share with the ABA to disseminate postcode data about where the complaints are coming from in each state by postcode, so sort of top 5 states and postcodes. And I think you'll find they're sort of they're not regional, but they're outer metropolitan suburbs where there's a lot of new housing development, for example. So it'll be interesting to have a look at. Systemic issues. So you'll all probably know that AFCA has, as part of its mandate, a requirement to look for issues that might affect more than one complainant, and we're required to report those to the regulator after investigating them if they do turn out to be a potentially systemic issue. So as has been foreshadowed, and as this graph quite clearly shows, we have had a really significant uptick in systemic issues being referred into that systemic issues team for investigation. So I will just clarify that this is not the number of systemic issues that were found to be systemic, but matters of concern that were raised with that team. There has also been an uptick in the number of matters reported to the regulator, though. This graph actually shows between, well, for the last financial year, a 53% uptick in those those referrals. So it's financial. I should just mention it's financial difficulty and debt collection, which is closely associated in our data. So if we go over to the next slide, I'll give you a sense of what we're seeing. So there we go. 21 definite systemic issues reported to the regulator. Now, if you've ever had a systemic issue reported to the regulator, you'll be aware that often results in sort of large remediation programs and regulatory attention. So again, we really hope to sort of resolve these early and help our members address any issues that might be affecting more than one of their customers. So where are they coming from? There's a list here of the top issues in this space, and they start with Section 72 of the NCC. I think there is just sometimes some misunderstanding about the notice periods for when enforcement action can be taken, for example, after the decline notice is issued in the 14 days. I think there's sometimes just processes that don't adequately account for some of the requirements, and that can lead to issues. We're also seeing that there's not always enough consideration in the process given to identifying consumers who are vulnerable and assisting them through the process. It doesn't mean that vulnerable consumers cannot have, for example, enforcement action taken against them if they've reached that stage. It's more around the extra care that's taken of those consumers through the process. Continuing collection activity while there's an open complaint with AFCA continues to be an issue, and I think again that's probably one that's down to the processes not taking into account when or having a trigger, that pauses enforcement action in another part of the organisation when the AFCA complaint is on foot. Now, I understand that it can be a frustration that sometimes complaints are lodged, sometimes deliberately. I acknowledge that happens. Complaints can be lodged as a way to fend off enforcement action. We do need to consider every complaint that comes in and consider whether it is a legitimate complaint. If you've been going around and around in a cycle where it seems like the complaints are not legitimate, then we have an ability to provide consent, to consider that and provide consent for enforcement action to continue. But going ahead with enforcement action despite the fact of an AFCA complaint, is certainly not okay unless you have that consent. Other things I would just call out, I was having a look through these last night, the way financial counsellors are dealt with in the process. So barriers to accessing hardship and your process is one of the systemic issues we've had, and that often relates to what documents are required, whether the documents are really required, whether the person is, if they're living in their car at the time and they can't provide the documents, what assistance and care is given. But also we're finding, and we get some feedback from the financial counsellors about this, that sometimes there's an awkwardness about how financial counsellors are engaged in the process. Some firms are requiring that a financial counsellor be attached to these complaints, and that is never a requirement for going through the IDR process and shouldn't be a barrier. On the flip side, sometimes financial counsellors are not recognised when they're appointed as the representative, and financial firms are continuing to contact the complainant and not recognising the financial counsellor. So neither of those things are good. We hope that actually sometimes the financial counsellor can assist in these situations, and they should be recognised where they're authorised, and that's pretty much as simple as that is. I think otherwise, accuracy of credit reporting and default listing issues are there as well. So we are always investigating these issues. We don't do it secretly. We'll come and talk to you if you have a systemic issue that's been referred. But here is a good sense of what you should look out for and try to avoid. Okay, this time I know who I'm handing over to. It is actually to the wonderful Chris Seamers, who is going to take you through an overview and probably answer the question that's in the chat around extra care, an overview of the requirements, and will at some stage later also be running us through some great case studies along with James Taylor. Thanks, Chris.
Right. Thank you, Nat, and hi, everyone. So over the next 15 minutes or so, I'll be taking us through financial hardship obligations for consumer lending. Just looking at an overview of this session. The next slide, Carla. The session will set out some reminders about financial firms' hardship obligations. We'll consider the life cycle of a hardship notice. I'll highlight some common hardship issues and themes that AFCA has observed, and I'll briefly focus on some areas that AFCA considers financial firms can improve regarding hardship responses to help avoid AFCA complaints ultimately. So let's first consider what the law and relevant code obligations state. Next slide, thanks, Carla. So financial firms' hardship obligations are set out under Section 72 of the National Credit Code, or the NCC for short. Additional obligations are set out more descriptively in the Banking Code of Practice. So for financial firms who subscribe to the Banking Code of Practice, Chapters 39 to 41 provides the financial difficulty obligations of subscribing firms. And importantly, Chapter 14 of the Banking Code of Practice sets out additional obligations to provide extra care to customers who are experiencing vulnerability. And I note the question in the chat is to define what extra care looks like. It's not really AFCA's role to define that. It is set out pretty descriptively under Chapter 14, but ultimately your processes should allow for the identification of a vulnerable customer and provide adequate and appropriate care to that person depending on their circumstances and the vulnerabilities that they may be suffering or enduring at that time. So every individual customer would look quite different, and we would expect when reviewing a complaint of a vulnerable complainant, we would expect the financial firm to demonstrate how they have provided that extra care to that customer. The slide we're on now shows an overview of what AFCA expects the financial firm to do once on notice of a customer's hardship. These obligations are of course set out in the NCC and can be broken down into these 4 steps. So with reference to section 72 of the NCC, let's break down each of these steps in order. Firstly, the customer does not need to specifically mention the term financial hardship or financial difficulty.
Can I just check, Sue-Ann, have you got your mute on?
Bit of
Thank
feedback
you.
there, that's better.
Sorry, please.
Thank you. Still getting a lot of feedback there. No, that's cut off now. All right, so the customer doesn't need to specifically mention the term hardship or financial difficulty. They need to raise a hardship notice, and they can do this verbally or in writing. And it needs to provide a reasonable trigger to notify their financial firm that they will not be able to meet their contractual obligations. And some hardship indicators might include notices such as I've lost my job, perhaps I'm about to go into hospital, or I've just come out of hospital, I was injured and can't work for X amount of weeks, perhaps I'm caring for an ill family member, and so forth. Noteworthy though is that a customer may tell their financial firm that they're struggling financially due to the rising cost of living, and this would also be considered a hardship indicator. In circumstances where the financial firm has accurately described the customer's right to request hardship assistance, however, the customer then advises that they won't need assistance as they have a reasonable and realistic alternative way of meeting their obligations, then the financial firm's hardship obligations may be discharged at this point. And this is because it provided the customer with their right to apply for assistance, but the customer did not wish to proceed at that point. However, the financial firm must not place obstacles in the way of a customer requesting assistance. So during an AFCA complaint, if the financial firm tells AFCA the customer declined hardship assistance, then we would expect that firm to provide AFCA with well-documented and descriptive contact notes showing that this occurred, and ideally the firm would have provided a response to its customer in writing to confirm the customer declined assistance and what would happen next. A customer's frustration at the financial firm's hardship process, or perhaps them not wanting to provide further information, perhaps due to the stress or confusion, this should not be considered the same as a customer declining hardship assistance, and the financial firm should still consider the request and an appropriate outcome, which may of course include a written decline notice. This will reduce customers falling through the cracks, so to speak, and reduce any confusion a customer may have about whether they're on a hardship arrangement or not after they provide a hardship notice. Once the financial firm's hardship obligations has arisen, it may need to obtain further information about the customer's specific circumstances, and this may involve requesting some additional information, particularly financial information. If the hardship notice is provided over the telephone, well, supporting information can also be gathered over the phone, and it may not require additional information to be provided. And this is particularly good practice for vulnerable customers or customers who appear overwhelmed with the thought of completing a statement of financial position, for example. If the financial firm needs this additional information, it should never be onerous, and it should be relevant information directly related to making a hardship outcome decision. Any additional information must be requested as soon as possible, of course, and no more than 21 days after the initial request for assistance. And this next slide shows some examples of additional information a firm might need, and again, it needs to be relevant and not onerous or cause an obstacle to the customer to apply for assistance. Usually a statement of financial position is all that is needed, but depending on the situation, the firm may ask for additional supporting information. This brings us to step 3, and whether a customer provides that reasonably requested information or not, the financial firm must still give genuine consideration to its customer's hardship request, and it needs to be based needs to base its considerations on the information that it does hold rather than focusing on any information which was not provided. Any hardship outcome provided must be relevant to that individual customer's request and needs. The outcome should not be a generic tick box arrangement that ultimately is not designed to assist that individual customer. And sometimes customers don't want to or they can't provide the requested information to support their hardship request. And as mentioned earlier, this is not the same thing as them not wanting to apply for hardship assistance. There may be reasons why they don't want to provide the information, and even if they don't provide requested information, often the financial firm may already hold enough information to make a hardship outcome decision. For example, many financial firms will request a statement of financial position to support a hardship request as a first step. And of course, this is a great way to understand what is happening financially for that person. However, in a scenario where a customer has just advised in the initial hardship request that they have no income for say 1 to 3 months, then a statement of financial position may have little to no value, at least initially. In this scenario, the financial firm should already have enough information to show there is not a lot of need for a statement of financial position immediately, as there is no income. And it knows the duration is up to 3 months in these circumstances. So an initial moratorium may be all that is needed to get this person out of this stuck situation. So if this is an initial request for assistance, the financial firm already has enough information to provide genuine consideration to the request. And as I said earlier, it should not focus on the absence of a statement of financial position, which wouldn't necessarily be relevant in these circumstances. However, and most importantly, it would be necessary to request a statement of financial position if the customer has already been provided assistance but now requires further assistance, or perhaps in a scenario which actually requires a statement of financial position, such as a reduced payment arrangement or a serviceability arrangement. A financial firm shouldn't agree to provide payment arrangements without first satisfying itself that it is affordable. Therefore, an understanding of the customer's finances and affordability is needed for that outcome. So this brings us to step 4, and based on the information the financial firm holds, it must provide a written outcome to its customer. Let's break this down into the A and B outcomes as set out in section 72.4 here. So in the scenario where there is an appropriate arrangement which can be offered, this arrangement must be suitable and it should be tailored to that particular customer and their request. There are unfortunate scenarios where the only appropriate outcome may be to allow the customer time to sell a secured asset under the loan contract, and this might be after the customer has not been able to overcome their financial hardship despite the firm working with them to assist. And of course, where there's no sign of their situation improving. So the sale of the security may be the only reasonable outcome, particularly in circumstances where providing any further time without payments would likely place the customer in a worse financial position the longer the situation continues. In these circumstances, a time to sell arrangement should be considered as a hardship arrangement for the purpose of section 72 of the NCC and for credit reporting purposes, such as disclosing financial hardship information and repayment history information on a customer's credit file. In circumstances where the financial firm does not agree to provide hardship assistance, or if the customer does not agree to accept the assistance it is offered, then the financial firm must write to its customers or customer setting out the reason that hardship assistance has not been provided. And this is an important notice because it allows the customer the opportunity to understand why the assistance was not provided and avoids confusion. The decline notice must be provided in writing to the customer. So whether the outcome is an appropriate arrangement or it's a decline notice, the next slide shows that on section 72.5, the NCC sets out the timeframes the financial firm must provide the hardship outcome to its customers. So just very briefly, this is within 21 days after the day of receiving the hardship notice where no further information is needed. or within 28 days after requesting any additional information under Section 72(2) of the NCC, but the customer does not comply with the request, or within 21 days after the day of receiving the requested information from its customer. Once a written decline notice has been sent to the customer, the financial firm must wait a further 14 days before it recommences any collection or enforcement action. The only time this is not required is where there has already been a previous hardship request declined by the financial firm in the previous 4 months, and the new hardship request is materially the same request, which has already been declined in writing. And this next slide shows everything we've just been talking about as a life cycle of a hardship notice. So rather than go through each step again, that slide shows each step that must be taken before the hardship obligations of a financial firm is discharged. So having a look now at some common issues and some areas that AFCA considers financial firms can improve in the hardship space. So the common issues AFCA has observed regarding hardship complaints coming into AFCA. One concerning observation is financial firms missing a hardship trigger altogether and instead continuing collecting on the debt, or perhaps it seeks to set up a collections arrangement, such as a promise to pay without going through the hardship steps required under the NCC. Other issues we have seen is that the hardship application and process is sometimes just too difficult for a stressed person. And many customers, particularly vulnerable customers, can drop out of the process and do not continue with their requests for assistance. And this is of great concern as these customers need help to get back on track, but maybe falling through the gaps, and their situation, which was possibly salvageable initially, then can become unmanageable. Another concern is financial firms providing a generic outcome which is not tailored to that individual and their personal circumstances. This might include providing a generic 3-month moratorium on repayments where perhaps more time was required to overcome an illness, for example, and also where there would be outstanding arrears at the end of the arrangement. This also needs to be included in the arrangement to help the customer fully understand their obligations and to ultimately recover from their hardship. The arrangement must not just kick the can down the road, so to speak, but should be purposely designed to provide the individual with the pathway to recovery from their hardship, if at all possible. In other words, it should be designed to help that particular customer get back on their feet and back on track with their payment obligations. Another issue AFCA sees often in complaints is where the financial firm fails to provide a written decline notice, setting out the reasons for its decision to not provide assistance. And this often leaves customers confused, frustrated, and sometimes they even assume they're on an arrangement when in fact they're not. ASIC released its hardship report in May of this year, and ASIC found that generally lenders weren't doing enough to support customers experiencing financial hardship. ASIC found several concerning trends, including things like firms ignoring hardship notices, firms' hardship processes being too confusing and frustrating for customers, which resulted in heightened levels of stress and anxiety for customers who were already struggling. ASIC found that firms often adopted standardised approaches to dealing with financial hardship, and this approach did not take into account that each customer's situation is unique and the solutions need to be tailored accordingly. ASIC also found that firms didn't make it easy for customers to give a hardship notice and didn't communicate effectively with customers always, and that vulnerable customers often weren't well supported. So that takes us to some areas which AFCA considers that firms can improve on. And here are some hardship areas where we think firms can improve on, not only to help to reduce the amount of complaints being lodged at AFCA about hardship, but also to provide the best possible assistance to your customers to help them to overcome their hardship. So the first one there is to ensure the hardship process is easy for someone under stress to navigate. And for example, there should not be any obstacles put in the way of a customer obtaining hardship assistance, particularly if the process is too difficult and the information request is too onerous. The second one there, ensure frontline staff are trained to identify hardship indicators and triggers and respond appropriately. That way hardship notices won't be ignored. And provide a tailored hardship outcome relevant to the individual request for assistance. Consider the individual person and their circumstances behind the hardship request and provide tailored outcomes that will actually help that individual. And fourth, ensure frontline staff are trained to identify vulnerable customers and effectively communicate with them. Providing extra care to customers who need it the most. And this might mean taking a statement of financial position over the phone, for example, as I mentioned earlier. Maybe consider providing a one point of contact for them so they don't need to keep repeating their story to different people. And ensure relevant referrals are provided, such as to a financial counsellor. And finally there, ensure the customer is provided with clear communication in writing about the outcome of their hardship request. And this is particularly important when deciding hardship assistance to avoid any misunderstanding and confusion. This will also help the customer to know what happens next, which is most important. So that brings us to the end of the consumer hardship requirements, and James will next take us through financial difficulty obligations for non-consumer lending. But before we move on to James, were there any questions about consumer hardship requirements?
I think we've done a pretty good job, Chris, of answering the questions as we go along. So
perfect. And there may be some time at the end anyway if somebody thinks of something. So James will now take us through financial difficulty obligations for non-consumer lending. Thanks, James.
Thanks, Chris. In the small business financial difficulty area, we'll look at three things initially with a case study at the end if there's time. Those three things are primarily the BCOP, the Banking Code obligations for small business lenders, but two subsequent things I'll mention that might be relevant or that do relate to the question is default interest for farmers under the Banking Code and the new small business restructuring practitioner process. And as I said, case study at the end if we have time. In terms of the law and code obligations, AFCA is alert to the fact that the NCC, the provisions that Chris has just been primarily running us through, do not apply in the context of a corporate borrower or a sole trader or an individual borrowing primarily for or predominantly for business purposes. So in those scenarios, while the NCC provisions don't apply, it doesn't mean that there's no obligation on the lender. We do consider any code obligations, and in the case of ABA members, that would be BCOP or prior to that, the Code of Banking Practice. And the AFCA member is also subject to AFCA's overall fairness jurisdiction under our rules. But the primary thing I'll look at now is the Banking Code of Practice financial difficulty obligation in relation to small businesses. However, a quick note of caution, and just on the next slide, if you could, thanks, Carla. A quick note of caution is in considering whether the NCC does or doesn't apply, occasionally we will look at the underlying purpose and a business purpose declaration. This has come up a few times, not often, but a few times. That is where a lender says, NCC doesn't apply, we have a business purpose declaration, let's move away from the NCC. And occasionally we've found that the lender does have knowledge, despite obtaining a BPD, a business purpose declaration, the lender does have knowledge that the real purpose, the substantial purpose, the predominant purpose is personal. And in that situation, we will say the NCC does apply, and hence we go back to the provisions Chris has been running us through in section 72 and following in the NCC. So section or subsection 13.3 of the NCC is the key provision we'll look at there in working out if the lender knew or would have known or had reason to believe if they'd made reasonable inquiries about the underlying purpose. So that's just a note of caution as we lead into the BCOP obligations. But in terms of if we conclude that the loan borrower was a corporate or the loan was predominantly for business purposes and the NCC does not apply, as I mentioned, we'll look at BCOP, and Chris has given a brief overview of the BCOP chapters and the provisions that apply. When we look at the code, as I mentioned, we'll look at the code that existed at the time of the relevant events at the financial difficulty obligations, primarily at the moment with 2019 being as the starting date. Primarily that's BCOP, but from time to time we will look at the prior version for significantly similar obligations in the prior version in any event. But those financial difficulty provisions in BCOP apply to small businesses in the same way that they apply to consumer lending, just without the overlay of the NCC. As Chris mentioned, we'll look at Chapter 14 for a sole trader who might be experiencing vulnerability and compliance with that provision. And then primarily for financial difficulty, Chapters 39 to 41 and the primary financial difficulty obligation on the lender. And we'll look to that in the next slide in a little bit more detail. So first, Chapter 39 is a couple of clauses which encourages the borrower and the guarantor to raise issues, financial difficulty issues, to raise them with the lender. Chapter 40 and the clauses within that chapter refer to the lender agreeing to employ various practices to seek to identify a customer in financial difficulty. And we did have a recent complaint on this point, and it's something that Chris has mentioned earlier on the same principle rather arises in the NCC, and that is just because the borrower does not use the expression "I am in financial difficulty" does not mean the obligations do not arise. In this instance, the small business ran a leasing business, leasing out equipment, and came to the lender saying, I need to do something here. I'm going to have to sell a bunch of my capital, my inventory, the equipment I'm leasing out, because I'm really struggling. I'm going to have to do something. They had a hospitalization as well coming up, and they didn't use the expression financial difficulty, but the context, the substantive nature of the correspondence was clearly that they were in financial difficulty for a short-term period given the hospitalization. So that's Chapter 40 and the clauses in it. And then Chapter 41 and the clauses in Chapter 41 contain a bit more of the detail as to what the firm will do once those provisions are triggered. They're to work with customers on a case-by-case basis, similar to what Chris has been describing under the NCC. I find in BCOP, that third bullet point there, the examples, there's a table in my copy anyway, it's on page 47, of BCOP, and it's got, I think, a really helpful table of the kinds of things the bank indicates or the subscribers indicate they will do to assist customers in financial difficulty. That's a great table, I think, to look to, not as an exhaustive list, but as a good illustration of the kinds of things an ABA member should be doing and could offer in appropriate circumstances. And then similarly to the NCC, the bank is to provide a written note response about its whether it accepts it can provide assistance. That might be in the business context, might be a letter of variation varying the loan to change payments, increase terms, or provide some other assistance. And if it's not agreed to, then the letter should go out providing or indicating some reasons as to why the financial hardship application has not been agreed to. And one small difference between the BCOP provisions and the NCC is while both of them require that written notice, BCOP doesn't have has a time period within which that notice is to go, but we will still look to see that it was sent if hardship or financial difficulty rather is declined. So they're the primary provisions on the banking code. Just as a sidebar, I note the new code from early next year will be substantially the same. I think it's slightly different. There's a slightly broader definition of financial difficulty than the one I've got listed there in clause 157, but substantively it's similar. Moving on to farmers. Often in financial difficulty situation, default interest comes up or default is occurring. And just want to make sure everyone's aware of what's now clause 179 capital A of the code, which was introduced in 2020. And it is being carried forward, I think, in a different section, not in the default section, but a special farmer section of the new code in 128 and following of the new code. But for now, it's in 179A of the code. So if a financial difficulty either request or identification occurs in the context of a farmer, that's the first criteria. And the second criteria, where the loan was for the purposes of a farming operation. And then the third criteria is if the land for that farming operation is in drought or subject to natural disaster, then the lender has agreed, the ABA member has agreed in the banking code to not charge default interest or a fee in lieu of default interest. So we'll be looking at that as well in the context of farmers and farming operation loans. Another smallish issue, doesn't arise too often, but I just wanted to mention it in the small business context, is this new small business restructuring practitioner provision in the Corps Act. It's been around for only a few years now, and it's had a slow, very slow take up, but we have started to see a few of them. So I do get the impression it's word is getting out amongst the insolvency community. So again, for a small business in financial difficulty, one option that it could consider, if it's a corporation anyway, one option is to consider appointing a debt restructuring practitioner under Part 5.3b. And if the bank who's the lender, a secured lender, usually becomes aware that's occurred, it would be helpful to notify AFCA if a complaint is in process to let us know that the application's occurred, because as indicated here with the purpose of the provision, it's to assist the small business restructuring with creditors. So I think it's quite relevant in a financial difficulty context if it is being used. The next slide mentions a couple of the criteria for when it can be used. So as I mentioned, corporate borrowers, liabilities under $1 million. So for both the current version of BCOP and the future version, which is 3 and then 5 million, it's applicable to those small businesses. And similarly, it's applicable to small businesses under AFCA's threshold of under 5 million credit facility debt. And there's this extra criteria that it can be used. There's a restriction on its use for when a director of a company has previously been subject to restructuring within the last 12 months. But as I've mentioned, we've seen a few of these now. Your usual unsecured creditors seem to be participating and seem to be accepting significant reductions. It's quite quick, it's quite inexpensive, and if there's a statement of financial position provided, then it could be the unsecured creditors or liabilities in that statement are significantly reduced via this restructuring process. So please alert us if you are aware of it. And they were the provisions I was going to mention on small business financial difficulty, but we have a case study later on if we have time. Thank you. So I think unless there's questions, I think we are handing back perhaps to you, Chris, for a case study.
So I think there are 2 questions in the chat, James.
Okay.
The first is from Shane Scott. He was asking, for small business lending where you say that NCC may apply, would that only apply to a sole trader and not if the borrower was a company?
Yes.
Yes, okay. And then from Amit Chandra, regarding the comments around asset sales, the NCC appears to indicate credit providers reasonably believe the debtor would not be able to meet his or her obligations under the contract even if it were changed. An asset sale does not generally result in the continuation of the obligation, that is, it's paid out. While hardship is given in these instances to clients, is AFCA saying the NCC does not require an assessment of the continuation of the obligation for the purposes of Section 72?
When we think about the purpose of Section 72 and also the chapters in the Banking Code of Practice regarding financial difficulty, the entire purpose is to move the customer to a position where they can overcome their hardship. In circumstances, which is mentioned under subsection 3 of 72, where there is nothing to show that the customer is able to ever recover from their hardship, then an alternative to a repayment arrangement, for example, would be to allow that person to sell an asset which may be secured by the loan. So I guess we would be talking already down the track. Maybe the person's already had 1, 2 or 3 rounds of hardship, and they haven't been able to recover. So then the next step, the only recovery for this particular customer may be to sell the asset, which ultimately does fulfill their contractual obligations. I just note in chapter 41 of the Banking Code of Practice, it talks about helping your customer to find a sustainable solution to their financial difficulties, and any help will depend on the individual circumstances, and it'll be a case by case. So as I mentioned, that may be that ultimately the sale of the asset may form part of a hardship arrangement to help that person to sell the asset themselves, with an alternative to surrender that property if that sales process is not successful. Does that answer that question?
I think it does. Thank you.
All right. Let's move on. Just mindful of time now. We've got 24 minutes left of our session. Looking at the consumer case study, the first one here. So just a bit of background. This slide just shows the background. These complainants were a married couple and they had 3 joint loans which were secured over their home. At the time of coming to AFCA, these 3 loans collectively had just over $115,000 in arrears, which is extremely significant. And listed here is some of the relevant factors in this case. To help everyone understand how we saw this when it come to us. There'd been long-term hardship here, and the bank had been working with these customers for at least 4 years to help them to overcome their hardship. And clearly that hadn't happened. There was a previous AFCA complaint which was resolved by a resolution agreement at an early stage. Unfortunately, the complainants did not maintain that arrangement. They then told the bank, okay, our situation has changed and it's not ever going to improve. And then they asked the bank for time to sell the property, which the bank agreed to, and they placed that in writing as well to their customer. Unfortunately, at that time, it was at the time of COVID-19 lockdowns, and they insisted that they would not go ahead with the sale because it would reduce the amount of that they would get for the property. But despite all of this, the bank continued to support these complainants or these customers. They agreed to a number of different things to help them through the COVID period, including reducing interest rates on the loans. The bank also accepted reduced combined repayments for these 3 loans, and also offered some moratoriums at times to get them through some difficult situations. And then, of course, this complaint was lodged after the bank declined any further assistance because it was just going on too long. And there was nothing to show that the loans were either affordable or that the complainants were genuinely intending to sell. So I'm wondering what's everyone's thoughts. Did the bank meet its hardship obligations in these circumstances? Well, we shall reveal what AFCA found on the next slide. So the outcome, we did actually find that the bank met its hardship obligations. And this is because it provided extensive hardship assistance. These complainants were having shifting and changing events happen in their life, and there were materially different requests. And the bank continued to support them through those periods, including providing a resolution in a previous AFCA complaint, as I mentioned. Also, they continued to find solution to the customer's hardship and providing extensive time for them to sell the security property, including reduced payments and sometimes no repayments while the property was on the market. Each occasion, the bank did communicate clearly and in writing to these customers. And in the end, the bank appropriately declined in accordance to subsection 3 of 72. there was really no need for the bank to keep on providing further assistance where it was absolutely clear that there was no way of recovery for these customers. There was no way they were able to meet the contractual payments for an extended period of time. There was nothing to show that their circumstances would change. In the AFCA determination in this case, we required the complainants to sell the security property as well. So that just finally, just some learnings on this. It reinforces that banks need to make sure that they have trained staff who understand hardship obligations as set out under the NCC and also relevant codes of practice. Banks need to ensure they provide tailored and individualised approach to providing assistance. And in this case, all assistance was relevant to each of the individual requests, and the bank continued to work with them. The bank definitely provided out-of-the-box solutions to these customers. And also everything was provided in writing to these customers as well. There was no confusion. And that included declining hardship assistance where it was clear that their situation was worsening the longer they weren't making payments to the loan. And most importantly, during our investigations, the bank cooperated with AFCA and provided all relevant information to show that it actually had met its obligations. Next, James will provide a non-consumer lending case study. Thanks, James.
Thanks, Chris. As you're speaking, I just wanted to quickly, it occurred to me just to quickly go back to Shane's comment in the chat. I should have perhaps added, is some feedback. We do frequently see bank staff referring to the NCC applying in the context of company borrowers. So if I can provide that feedback, as it can sometimes be unhelpful to the complainant when the bank staff has been regularly referring to NCC in the context of a company borrower. In terms of the case study, the small business in this instance ran a investment. It's a company borrower running a couple of investment properties, commercial investment properties. In 2016, they refinanced to the bank in question. There were 3 loans. There was a sort of term debt, the investment loan, a smaller line of credit, and then a fairly sizable overdraft to help with the ongoing work needed for the properties. The 2 properties were the primary security for these loans, along with a guarantee from Mr. C, who was the primary director, driving director of the company borrower. From 2020 onwards, the C company was in difficulty and was falling into arrears. The reasons given were Mr. C was in a marital dispute, so he was distracted, time taken away from the business, and the business was also caught up in litigation, unrelated to the bank, unrelated litigation. And then I think COVID was a factor as well. And at the time the complaint was made, they were in about $500,000 of arrears. From 2020, the bank and Mr. C and the company, on behalf of the company, the bank were in discussions about the possibility of selling some of the security properties. Oh, and if I can also add, to go back to a comment Sue-Ann made on the data, this is an illustration, this matter as well, of a financial difficulty complaint not being included in our data on FinDiff, because the borrower here also brought up questions of appropriate lending, that is, that the loans should not have been provided. So in AFCA terms, this complaint was probably recorded as an appropriate lending complaint, not a financial difficulty complaint. But the financial difficulty aspect of it was a key part of it. The bank had been in regular discussions with Mr. C about the company's business and what it could do. Mr. C, a couple of times during 2020 and 2021 and into 2022, offered to sell some security properties. I think so it was in a consensual arrangement. They both agreed that it would be a good idea to try and sell one. So they were put on the market. The bank didn't take possession at all. They let Mr. C run that process, or the company run the process. And saying Mr. C makes it sound like happy days, doesn't it? But Mr. C had some difficulty agreeing on a sale price. Presumably, he became invested in the price that he thought was a fair price, and the sales didn't occur. And so for about a 2-year period, there were these ongoing discussions where the company sought to sell the properties. There was some initial resistance from Mr. C and the company in relation to the provision of a statement of financial position. They eventually did provide one, and it did show that the company was in significant arrears, and there was not a viable plan other than the sale of the properties. There wasn't a viable plan to be able to recover from those arrears and from that financial difficulty. So the message of this complaint for the third slide, the last slide, is that for customers in long-term financial difficulty, then with little prospect of recovering to be able to continue repayments, the sale of the security properties can be the best outcome. And AFCA here concluded that was the best outcome, quite particularly noting the regular contact between the bank and the company and Mr. C to try and find alternates, try and encourage alternates, but nothing really arose. So the bank gave Mr. C and the company significant time to try and sell the property. So and then the outcome for this determination in this matter was it gave the company 2 options to choose between. One option was just to sell, or 3 options, I suppose, to sell in 3 months or to provide possession of the properties to the lender. And then the third option was, okay, if you want to sell one of them and then commence repayments sell one of the security properties to repay some of the debt, and then to find a solution for a much smaller residual debt that was to be carried via one of the security properties only. Then that there was some time provided to try and work that out as one of the options. So that's the case study. Thank you. So Jess, I'm not sure if there's any other questions, or I can't see any in the chat.
No, I don't think any other questions have come through. I think members might be digesting the case study that was provided to them. I found it very interesting to listen to the specifics of each of the cases.
Jess, I think we're fine too. We're happy to share the pack, as we say, and the information, and take questions later. I think it's a lot of stats and information first thing on a Tuesday morning. So we're really happy to take questions afterwards and end a little early if that works.
Yes, let's do that. Let's close out. While I've got the mic, I might just say thank you to the AFCA team for presenting. I know that I speak on behalf of our members when I say that today's session was very informative and insightful. I particularly found the case studies useful, but also the summary of common issues that James and Chris put forward, including the mention that standardized forms or too many requests for information can be daunting for customers in crisis, and they can find it a bit inflexible and fall out of the process. I thought that was a really good insight. And I've seen there's some comments coming through from members saying thank you. So I'll just hand over to the AFCA team if you wanted to have any final comments before we close out.
Sue-Ann, any comments?
Sorry, no, thanks, Nat. I'm just grateful of the opportunity, and I echo your words that when people have had a chance to think about today, if there are any further questions, very happy to have them directed through to us and to deal with them. So thank you.
Thanks, Jess. Thanks for having us. We won't take up people's time. Everyone can have 10 minutes to get a coffee.
Yes. Thank you so much, everybody.
Thanks a lot. Bye.
Thanks, everyone. Bye.